Gene Gard, Chief Investment Officer at Telluride. I just wanted to talk for a minute about stock buybacks. It's kind of a controversial topic right now because with this plan that's just been passed in the Senate, it looks like it's going to become law. There's probably going to be a 1% excise tax on stock buybacks by companies. And I just wanted to talk briefly about, I won't really express an opinion on whether or not that's a good idea, but I think stock buybacks get a bad reputation as being some sort of handout to the rich or something, and really it's just like any other type of capital transaction. So what happens is, what is the point of the stock market to begin with? For the most part, the reason the stock market exists is so that companies can raise capital, so they can get money that they need to operate their business. That's the reason it exists. I mean, you could argue there's some other reasons, like if you're a founder and you want to get some money out of the company, and it's a way to sell your shares in a controlled manner. But ultimately, the entire reason the stock market exists is for companies to sell small pieces of themselves or large pieces of themselves to the public. The stock market is a public market, so anybody, for the most part, can buy on the stock market. But that's the purpose of it. So any company has something called a capital stack, or basically a way that there's very few companies, and certainly not large public companies, that are able to be sort of self-financing in the sense that they're just bootstrapped up from a small business that finances itself and grows. Almost all companies have to have outside owners, so they sell stock or otherwise sell ownership in the company to other people. Usually they almost always have some sort of debt through either bond transactions or bank loans, or there's various ways. And then there's all sorts of other little parts of what's called the capital stack, like preferred stock and convertible bonds and mezzanine debt. I mean, there's all kinds of different things you can do. But the bottom line is the stock market is just a way for companies to finance themselves. So when a company does an IPO or does a secondary issue of their stock, they're essentially selling their stock in the company, ownership in the company, in exchange for money they need to operate or expand. So there's nothing unusual about the idea of companies needing to sort of definance themselves. So one way that happens, when a company has extra cash lying around or has extra cash they've raised, the old-fashioned way to deal with that is they would pay dividends to their shareholders. That's not at all unusual. That's the reward for owning the company and seeing it improve. And most people say the whole point of stocks is for the ultimate cash flows they'll produce eventually. So they pretty much have to do that either by paying dividends or by selling themselves to another company, or getting acquired. So dividends is one way that companies can put extra cash to work. The tax consequences, the way dividends work, it's not necessarily the most tax efficient way to return money to shareholders. So actually stock buybacks make a lot of sense. Stock buybacks are a way that companies can take extra cash and go buy their stock back from the public, which allows them to put that cash to work, and it shrinks the number of shares that are outstanding. So even though the shareholders that continue to hold the company don't get any cash like they would with the dividend, they still do see their value of their shares improve. So just for example, if there's 100 shares outstanding of a company and you owned one of them, you would own 1% of the company. But if the company were able to buy back 50 of those shares, which that'd be a big buyback, but you wouldn't get any cash, but suddenly instead of owning 1% of the company with half the shares outstanding, now you own 2% of the company. So that's really just as meaningful, and in a lot of ways that's more tax advantaged. So there's nothing evil about stock buybacks. There's nothing nefarious. It's not a handout for the rich. It's not, I think the people who are big opponents of buybacks don't really fully understand what they are. Really, it's just like a capital transaction. It's just like issuing new stock or doing an IPO, just sort of in reverse. So if anything, it's a little bit more shareholder friendly. And that's one reason that some of the old-fashioned approaches to investing, like dividend investing or dividend aristocrats, it doesn't quite work the way it used to, because some of those companies that would otherwise pay dividends don't pay dividends because they're buying back their shares, but they're still very much valid dividend paying like companies, but they just wouldn't show up in a dividend screen, if that makes sense. So this excise tax, it's a very real thing. It affects everybody, just like a tax on dividends. I mean, dividends are already pretty heavily taxed, but it affects you if you have stocks or mutual funds or a 401k plan. I mean, it's real money that's being extracted from the capital markets as a tax. So whatever your opinion is on taxes, you're entitled to your opinion, but it's a very real thing, and it doesn't just affect the rich. Ironically, one of the things they discarded in this bill was a tax on carried interest to treat it more like income, which actually probably would have more effectively targeted the highest net worth, wealthiest people, which if that's your goal, then that probably would have been more effective at this, because this is really a tax on Main Street, everyday people. Like I said, just like a dividend tax would be, or really anything that affects the stock market. So I hope that's useful to understand sort of how buybacks fit into the world and how they can affect you, and how this excise tax that they're proposing is a very real tax on you and me. So hope that helps. Let us know if we can help with any other types of discussions or videos.